Hello students, welcome to Legacy IAS Academy. In today's video, we are going to discuss a very interesting phenomena that is being observed where the Indian rupee's value is continuously falling against the US dollar. So in this video, we are going to discuss in details about what kind of fall we have witnessed in the last few days, what is the factors that is behind this kind of fall, what are the general factors that affect the value of one currency vis-a-vis the other currency, and what are the factors that are currently in the play as far as the Indian and US economy is concerned that is related to the decline in the value of Indian rupees. So without further ado, let us try to understand this topic in more detail. So first of all, to give you the context of this particular topic, currently for the first time, Indian rupee has breached the mark of 85. What it basically means that today $1 is equivalent to 85 Indian rupees. That means if you want to buy $1, you will have to simply pay rupees 85. If you try to understand, in the April month of the same year, the value of rupee was somewhere about 83. And if you try to compare it with the long term value, when the Prime Minister Narendra Modi took charge or helm of India somewhere back in 2013, at that time the value of Indian rupee was 61. That means $1 was equal to 61 rupees. So from 61 to 85, almost we can see 24 rupees of decline that has happened in the last 10-11 years. As such, the rupee has been weakening in value related to the dollar. Now, this is not a recent trend or something that we can say is the reversal of the trend. It is simply the continuation of trend that has been going on for almost, we can say, 1970s and further in 1990s when the Indian economy opened up after the LPG era. So if you try to understand the change of the values of Indian currency vis-a-vis the major global currencies of the world, so Indian rupee, as we can see, it not only has declined against US dollar, rather its value has declined across all the major currencies, be it UK pound or sterling as we can call it, euro or United States dollar. To give you an idea, if you start somewhere at the year 1970-1971, the value of $1 was equivalent to 7.56 rupees, while the value of 1 British pound was equivalent to just 18 rupees. And since then, if you look at the recent time of 2020, 21, the UK pound today, 1 UK pound is equivalent to 104 rupees. 1 US dollar today, as we know, it is above 85 rupees. 1 euro is also about 90.95. So euro, what we are seeing, obviously euro was introduced in somewhere in year 2001. So from there we have the data of the euro versus rupee exchange rate. Now the question that comes into mind, that what do we mean by the term exchange rate? In simple terms, we can explain the exchange rate refer to the rate at which one currency can be exchanged with the other currency. And this exchange rate plays a very vital role in determining the trade volume or trade value, the movement of goods, movement of the services across two countries or across the international border. Now let us try to understand this from an example. Now suppose a person from India, he suddenly got huge amount of money. In this case, we can take example of our Babu Bhaiya. Now suppose Babu Bhaiya has won a big lottery and now he is not anymore interested in buying Indian car or going to vacation within India. He now want to travel to United States. He now want to travel in a German car such as BMW, for example. Now, obviously, he can buy this car from India also, but let us suppose he planned that he will directly import the car from Germany. Now, since this car is made in Germany, Babu Bhaiya cannot pay the Indian rupees to buy this car. So first, what he need to do? First, he need to convert the Indian currency that he has with the euro, because that is what is acceptable in Germany. So the value at which he will be converting Indian rupees into the euro, that is called as the exchange rate. Similarly, suppose Babu Bhaiyas have made a plan to visit Statue of Liberty in the USA. Now he cannot take the Indian currency and go to US because he cannot pay there as it is not acceptable. So first what he need to do? He need to convert the Indian currency, Indian money he has, into the US dollar. Again, the rate at which he will get the US dollar is what we call as exchange rate, that today stand at 85 rupees. That means Babu Bhaiya will have to pay 85 rupees for getting 1 US dollar, and then he can go and travel in the United States. So this is how we can understand the exchange rate and how the currency's rate keeps on fluctuating. Now this is about the exchange rate. The question comes that why exchange rate is not fixed? Why would not have all time 1 US dollar equal to 60 rupees or any other value? exchange rate keeps on fluctuating, and the reason behind this is, if you look at the market, one market is where you are basically exporting and importing goods and services, and then you are exchanging the currencies. But the currency market itself is a big market where the every currency can be considered as a commodity, which itself is exchanged between two different individuals or entities. So basically, as the price of any goods is determined by the demand and supply. If demand of good is very high, what will happen? And if supply is less, the price of goods will go up. Similarly, if the supply is very high, but there is no one who wants this goods, that means demand is very less. In that case, the price will go down. And same thing happens with the currency also. So the basically we can say the exchange rate of any currency, in this case Indian rupees, depends on to what extent its demand and supply is available in the market or present in the market. In simple way, you can understand that if Indians demand more US dollar than the Americans demanding the Indian rupees, the exchange rate will tilt in the favor of US dollar, because in this case what is happening, demand of US dollar is high, demand of Indian rupees is less. So Indian rupees price will go down, US currency or US dollar will appreciate. So US dollar will become relatively more precious, more valuable, and more costly in nature. Now, if this is a short-term phenomena, again the currency and exchange rate will stabilize. But if this trend becomes a long-term trend, in that case, such continuous appreciation of US dollar vis-a-vis Indian rupees will become more stable in nature, more long-term in nature, and more permanent in nature. And this movement will show up in the form of rupees exchange rate weakening against the dollar, or in reverse way, if you understand, dollar strengthening against the Indian rupee. So it completely depends on the demand and supply, which currency is in higher demand, which currency is in lower demand. Now that is the first point. Now the question comes that what itself is affecting the demand and supply of currency. Why currency demand of US dollar will be higher than the Indian rupee, or in some cases opposite to that. So that is dependent upon three major factors. For example, let us assume we have a world where only two countries exist, that is United States and India. And it is only these two countries which are involved in the exchange of goods, services, or investment into each other's territory. Now let us take example of the trade of goods. Now in the case of trade of goods, suppose that today America exports more value of goods to the India than India exports to the USA. Now suppose if an American want to buy an Indian good, in what currency he will have to pay? Obviously, he will have to pay in the Indian rupees. So there will be a demand for him, demand for the Indian rupees, that will be seen increasing. Secondly, if an Indian consumer want to buy something from America, in what currency he need to pay? Obviously in US dollar. So again, the US dollar demand will increase. So it depends upon the strength of the buyer. If more Indians are buying goods from the America as compared to more Americans buying goods from India, in that case the demand of dollar will go up and the demand of rupee will be relatively low, leading to the appreciation of US dollar as compared to Indian rupees. Let us try to understand this in more detail by looking at the actual situation that we have. Now, let us understand that if we talk about the global trade that we have today, most of the global trade is settled in the US dollar. And if you try to understand globally, India's exports and import values for the recent months have been given here. Now, if you look closely, India is exporting almost, we can say, up to 30 US dollar, $30 billion worth of values of goods. And on the other hand, India is importing about $69.95 billion worth of the goods. So there is more demand of the foreign currency because you are importing more, you are buying more outside of India. So since the most of trades are settled in US dollar, in other words, we can also say there is a much more higher demand for US dollar. That has caused the US dollar to go up. Similarly, if we talk about the export of India, it is relatively very less. And what is export? You are exporting only when someone is buying outside some Indian goods, they are buying from US, for example. So because this value is very less, there is very low demand for the Indian rupees. So there is a low demand of Indian rupees, there is a high demand of US dollar, and this is because of the trade deficit India runs. That is one way how we can understand that the currency's value can fluctuate and can depreciate. Same thing we can apply in the concept of trade in services. We know that whenever we are talking about the bilateral trade, especially between India and United States, It's not only the goods that are exchanged between both the borders, it is also the exchange of services such as software services, IT based services, as we can understand. And third is obviously the investment. That means an Indian investor is trying to, let us suppose, invest in the American market, or an American investor is trying to invest in the Indian market. Now, in the case American investor is trying to invest in the Indian market, he again will need Indian rupees. Similarly, if Indian investor is trying to invest in the American market, he will want the US dollar. So, all of the changes that happen in the trade value volume of goods, services, or investment affect the exchange rate. Now, let us try to understand that what are the factors that affect the changes that happen in the case of trade. So, let us suppose we know that rupee will depreciate if our export to US declines or US import from India declines. Both are same. How it can be possible? Now we know that President-elect of US Donald Trump is going to take charge the office in the January month of 2025, and he already is hinting and giving the signals that he might impose higher tariff on the countries such as India, China, Canada, Mexico, etc. Why? Because he believes that the Indian goods are not tariffed at a rate that Indians are tariffing the US goods. Now suppose when the Trump decides to finally impose tariff on the Indian goods, what will happen? The price of Indian goods will shoot up in the American market. And if the price of Indian goods shoot up in the American market, obviously the number of consumers willing to buy it will decline. Now, if the number of consumers willing to buy the Indian goods in American market decline, that means the demand for the Indian rupees will decline, because it is in this currency the goods would have been bought. So overall, what will happen? The import volume of US from India will decline, or export volume of India to US will decline. Due to this, there will be further trade deficit that will put further downward pressure on the Indian currency. Second, we have discussed about the investment that also to some extent impact the rate or the exchange rate of the currencies. So suppose that inflation rate we can take into account. Let us say in US inflation rate is 0%. In India, inflation rate is 4%. So if an American investor wants to invest in India and he is getting a return of 10% from the market, due to the 4% of inflation rate, the actual interest which he is getting, or the actual return on the money invested he is getting, is only 6%. However, if he invests the same money in the American market, since the inflation rate is 0, let us suppose that American market is giving him a lesser interest of 7% only. Still he is getting 7% of full return because inflation is 0. So for him, it would make sense to invest in the domestic US market rather than investing in the Indian market. So when such situation emerges, what we see is that there is a lack of investment into the Indian economy by the American investor in this case, or those investors who already have invested their money in the Indian economy, they start to pull out their money or withdraw the money, either to invest in the US or to such economies where the rate of interest is slightly more. In this case, what we are seeing that currently China and the Hong Kong are offering much more better interest rate, higher return rate as compared to the Indian market. So that's exactly what is going on here. At present, the investors are pulling out money from the Indian market. That means the demand of rupee has remained same, but the demand of US dollar has increased. So basically, that is how we can understand the factors that has affected and put a downward pressure on the Indian rupee vis-a-vis US dollar. That is all for this particular video. Thank you very much.